Stop. How can you lead a team if you can't lead yourself? If your life depended on whatever it is that you're doing today, right? Would you go about it differently? Did you leave it all out there? Because anything worth doing is worth doing right.
I've got this right. I'm maybe just doing it wrong. That's the bigger, greater definition of focus for me. If you're the most determined person, but you have no idea what you're doing,
Good morning. Boy, I don't know. That was weird. I don't know if it's my internet or if it was the connection or it's StreamYard. Am I coming through okay? I don't know. I think that might have been Jenna. We lost Jenna. All right. I assume I'm coming through okay. Let me just all right, good morning. I think Jenna lost internet. I assume I'm coming through okay. Seth, give me a yeah, okay, great. Thank you, Bob. I reset my internet connection thinking it was me. Gotta love technology. What you probably also love this morning is bond yields down to, or 10-year down to 444 and change. Okay, cool. Thanks, Seth. Coming, 5 basis points better on the day. Solid rally. 4.5 coupon looking pretty good, maybe up 11. UMBS, or what I like to call fannies, what we used to call fannies, perhaps outpacing Ginnies just a bit. Generally speaking, kind of bouncing off some of that support, perhaps feeling a little bit better. And let's sort of take a look at the markets here. Share my screen on that. So overnight, stocks a bit mixed. I'm going to talk about the VIX here in a minute. And I don't know. I think as you get older, you get a little bit more, as they might call it, crotchety. It's like, VIX is up 3% yesterday, down 3% today. And again, I get it. I've talked about this, that volatility is some of our friends, but it does get fatiguing, right? Like one day we think rates are going up, the next day we think rates are going down. And in reality, with a former partner who would overreact to everything, we had a timeout rule. At one point, after calling a million meetings over nothing, right? We said, listen, if you get an email or somebody says something that pisses you off, you cannot speak about it. I forget if it was for 24 hours or 48 hours. And boy, I'll tell you something. If 95% of what was in the potential freak out didn't resolve itself easily in many cases in that cooling off period. And there are times where, you would just wish, just for kind of sanity a little bit, if we had that in the financial markets. Maybe I'm oversimplifying, but there's absolutely almost nothing that happened yesterday that would lead us to believe that rates should be higher, that are going to happen today that would lead us to believe that rates should be lower, that's going to happen tomorrow that should lead us to believe that rates are going to be higher. I just don't believe it, right? And I say that, not as a cynic or a skeptic. I say that as somebody who's been in the financial markets for 38 years. And there are few examples and of a singular occurrence that has contributed to a sustainable long-term pattern. Sure, the fall of Lehman, the uncovering of COVID. I mean, there are certain events that are a tent pole or a swan-like event, but a single data point, right? Or you look at what we're trading insofar as the day-to-day opening of the strait and so on and so forth. If you took a poll, I don't believe anyone would tell you that they believe that the strait is going to be closed forever, right? And as President Trump has exhibited, right, there is a short-term solution to the strait being closed, which is that there's far more oil than anyone wants to, lead on us to believe, right? And so you open up some reserves, and the next thing you know, in the near term, problem solved. Anyway, that's sort of the old man in me, I guess. Overnight, stocks mixed, both in Asia and Europe for the most part, indicating positive here onshore. VIX down again, commodities. Listen, again, barreling, pun intended, towards a 60 handle on crude, down another 3%. The silver trade, not that we're going to spend a lot of time on silver this morning, but let's see if we can get a chart. I don't know. I don't have an MBA in economics, but I'm going to tell you, not good. It's only $3, but let's see, just out of curiosity. Yeah, 1 month, not so good. 6 month, depending on how you want to look at it. But yeah, the last couple of days, silver has gotten beaten up a little bit. I don't know, maybe it makes sense. I'm going to look into that just because I'm curious. But so as goes oil, as goes the end or the continuation of this conflict, so goes interest rates. And did we get some? I didn't think there was 8:30 data today. Not really. I mean, building permits pretty much came in on the screws, slightly down month over month. To whatever extent we care, and in the mortgage business, we probably care. MBA apps up a bit, maybe about 1%. Refis up from 810 to 834. Purchases down from 170 and change to 169 and change. So sort of a nothing burger in terms of the mortgage application market outlook. Fives are up 5 on the day. Where are we relative to yesterday? Kind of tough to say. We're about 6 ticks better than 905, but when you look at where rate sheets probably printed, where maybe a tick or two better, we kind of sold off into the close a little bit yesterday. I'm guessing most rate sheets struck 5s somewhere in the 98.12 to 98.14 range. We got back down to like 98.10, and we're sitting at 98.16 round numbers. Last couple ticks negative. 5 coupon, yeah, you might see 2 ticks better on the rate sheet today. I doubt that there were any negative reprices yesterday, but to whatever extent there might have been, I would think that you'd be somewhat, I don't know, material is a big word, but materially better, maybe a quarter in fee, an eighth in fee. 6 coupon, yeah, pretty much right where we would expect it to be. Again, I think rate sheets today might be 1 to 4 ticks better. What call that 3 to 12 basis points in fee better. I don't think anything crazy. 10s look a heck of a lot more attractive than MBS does on a relative basis. This is one of those where I think that when you wake up and you look at your little doohickey, and I'll call it that because I don't know if you're looking at an app or you're looking at a website or you're looking at an email, but I think that you feel better about what you see than the actuality. To whatever extent 4.5 coupon is really up 11 ticks, that looks more impressive than it is. because you're not originating 4 and 4.5 coupon. So I think that some of this rally is all hat and no cattle, as they say in the great state of Texas, but it's better than selling off, right? Maybe this has a bit of an impact on some arms. Maybe, if you have, say, a builder forward who's buying down the rate 3, 4, 5 points, you have some borrowers doing something crazy, trying to pay 4 points. Maybe this rally matters a little bit more. But in the belly, this is sort of a nothing burger. I definitely feel better about it again than a sell-off. How do I trade this? We are not quite a week away from 4th of July holiday. And I say that because now I'll certainly be around and will be around, but I'm not stupid enough to believe that the world is actually putting in full effort next Friday, right? And what kind of stinks, here's a little old man disclaimer a little bit again. If we're not putting in full effort on Friday, I'm also betting that we're not putting full effort in on Thursday. I think one of the challenges I have sometimes with the workforce at large, our across all positions, is the anticipation. Like he's like, well, tomorrow's Saturday. Well, if tomorrow's Saturday, tomorrow's Friday, a day before. And if I'm looking at Friday like it's Saturday, I'm looking at Thursday like it's Friday. And it's like, so what are we doing? Tuesday and Wednesday, we're going to put in, and Monday is the day after Sunday. Second full week of summer or whatever, if you don't consider Memorial Day the first day of summer. So, this trading, the point of it is in the world that I care about, the financial markets, or I care mostly about, I guess I could say, trading is going to get pretty thin pretty quickly. So, how do we approach this? To me, this is a bit of a buy the dip sort of event. I didn't necessarily see anything tangible to kind of change our minds in a sustainable way overnight. We feel slightly better about oil and the conflict. Let me just pull down. I think at the end of the day, this is just really a buy the dip, lock the dip sort of event for me, knowing that we're going to get more and more illiquid. I think a good question is, given the price of oil, why for those, and we talked about this a little bit yesterday, to whatever extent, and so let me digress for a second. Who is my enemy here, right? Because being dramatic, but in the world of the financial markets, there's going to be a winner and there's going to be a loser, right? If I'm going to go long TBA, there's going to be another side of that trade. And then the moment I short the TBA, there's somebody on the other side of that trade. So, the long and the short of it is kind of who's my enemy here in terms of what the trajectory of interest rates, what is the trajectory of interest rates going to be here in the next whatever, week, 2 weeks, 3 weeks, 2 months. And that's the folks who are sort of pricing in 3 hikes. That to me is where you need to kind of focus your efforts. And in some of your investigation is, what percentage of the market is pricing in 1 hike? What percentage of the market is pricing in 3 hikes? where am I relative to that? You know, insofar as where tens and where MBS sit, ultimately, what percentage of these folks are offside, right? Because we have hedges on, and I might sit here and say, hey, I'm optimistic about rates in a month or 2 months, which I've talked about being, yet I have shorts on. And why would I have shorts on? Well, because, you know, I wouldn't consider that being offside. If I'm net grossly short, you know, that's me, you know, putting a trade on, having an axe, having a bias. Me just sort of hedging and covering, that's not necessarily a bias or an axe. So ultimately, the folks here who are super short, right? They're the first ones that are going to cover. And how quickly are they going to cover? And so I think that you potentially have a little bit of a reprice of the stack here and the count of hikes. Likelihood of Fed hikes. Let's see if we can get like a quick poly market. So July 26th meeting, Fed funds are indicating a 65% chance of a hold, 35 to 40% chance of a hike. September 26th meeting, market odds for an interest rate hike climb significantly, with some predictions indicating a 50% chance of a 25. So listen to this. So to my point of who am I, or who might we be betting against if we're betting on lower interest rates? And there's a bunch of ifs in there. 50% chance of a 25% hike and a 20% chance of a 50 basis point hike, right? So that is what to sit here and say that we're trying to make a play against the 25 basis point hike. That is a stretch, right? I think that a 25 basis point hike, the odds on are probably, the smart money is probably that's a fait accompli, right? Now, I personally don't think it is. I do think, not to contradict my earlier statement, that things could potentially get better, or in some small ways ugly quickly, for a hard pause on that. But so you have to sit here and say, and someone in my seat has to say, where do I see rates if we definitely get a hike? What are the potential outcomes of July, right? So there's no move. If there's no move and we're pricing in a 70% chance of a hike, you're going to probably see somewhat of a precipitous rally, right? 435, maybe something like that, pending the subsequent language on the hold. If they hold, but say we're definitely hiking next month, there's nothing that could stop us, that's a different story. But if we were to price out that 20% chance of a 50 basis point increase over the next 30 days, what does that do to yields? It probably has more of, and I say probably because I haven't done the math, it probably has more of a downward impact on rates than a single 25 basis point hike has on the upward trajectory of rates. Why? Because that's already priced in, okay? And then end of 26, as was indicated here, major, and this is their language, major institutions like Bank of America are now forecasting up to 3 hikes to curb resilient inflation and a strong job market. I do not see this job market as strong. We had a couple bad prints. We had, one good number. So that to me, and as I wind down here, if you have any questions, please post them, or any thoughts for that. Doesn't have to even be a question. You want to sit here and say, hey, I think they're going to do this or that, please put it in the chat. But long story short, at the end of the day, I do think that the market is somewhat offside. I don't see 3 hikes this year if all things are equal, right? Big if. But the good news is in that statement of if all things are equal, it's incredibly unlikely that that unequaling event isn't a one-time event. All right, we could see it coming. It's a month after month progression because the reality is that one-time event that's most likely is the definitive end to this conflict, which would be arguably massively deflationary, right? If I were to continue with my thought process that President Trump is going to give oil an opportunity to run, open the strait, continue to drill, baby, drill, or release the reserve, or both. And if he's hell-bent, he really has control over interest rates. This is an interesting moment in time, right? If you talk to me 100 times, probably 98 times out of 100, I'm going to tell you that neither the president nor the government nor the Fed have near-term control over interest rates. The bond market does, right? In this example, and I'm almost never going to say the president does, and then the other 1 or 2% of the time, I might say the Fed does because they're going to say something crazy that's going to catch the bond market offside. And I say all that with the caveat that actually only the government controls interest rates by printing money and creating leverage. But, again, throw back to Sir Milton Friedman. But at the end of the day, at this moment in time, this president, I believe, actually controls interest rates. I don't know if he realizes that. If he does, I would imagine he would exercise that control, which is very simple. The moment that this conflict ends, if he continues to flood the market with oil one way or the other, and if he's hell-bent on getting the price of oil to 40 or 50 bucks a barrel, you can rest assured that the bond market is going to reprice hikes and is going to reprice the inflation outlook. Full stop. And so I do believe we have a little bit of a backstop. So here's the wind down. All that being said, what we don't necessarily have is time. Tomorrow you've got PCE. We'll see. Next week you have light liquidity. We'll see. I think you lock the dip here. To whatever extent it's actually a dip, I think rate sheets are going to be pretty similar to yesterday. Yes, you're going to get a bump down in coupon. I like what I see happening down in coupon. That tells me that there are some bets that rates are going to move lower. So what I would say to you is kind of broken record. If you're 5 coupon or lower, what the hell do you have to lose? Unless you just took on a floater, I don't know, at our worst levels yesterday morning, at our worst levels on the 22nd, at our absolute worst levels on May 19th. If you've been floating since May 19th, might make sense to lock today, right? If you've been floating since June 8th, maybe, right? Otherwise, ride it out. What the hell do you have to lose? I think 5.5 coupon, which is 5 3/4 to 6 1/8, is probably a 50-50 proposition. I think time is your decider. You're 100% if you're closing in the next week. You're 25% if you're a month or two out, and you're 50-50 if you're closing sometime in the month of July. That's not next week or early the week after. And then I think 6 and 6.5. You're kind of, like this is a 3-month chart on 6.5s. So why aren't you locking that? I don't know. That was 6s. 6.5s, maybe. But then again, we've talked about the spec trade on 6.5s. So lock the dip. And if you don't, day to day. Tomorrow, I think we're going to like the report tomorrow. But there's a lot of risk there. Your risk factor is a 10 out of 10. I think there's a 6.5, 7 out of 10 that we're going to come out of that unscathed, maybe slightly optimistic. Bulls and Bears make money, pigs get slaughtered. Thanks for joining live and watching on replay. See you guys.